Hello and welcome to this latest Capital Economics webinar in our series looking at economies after COVID. My name is Neil Shearing, I'm the Group Chief Economist, and I'm delighted to be joined today by Simon McAdam, who's our Senior Global Economist, and William Jackson, who's our Chief Emerging Markets Economist. This series is an opportunity really for us to step back from the ebb and flow of the virus and focus more on the longer-term consequences, the economic legacy of the pandemic. Previous events, we've looked at globalization, the effect the pandemic may have on globalization. We have one next week where we'll look at the inflationary consequences of the virus. We'll have others look at the role of the state, the implications for different asset prices and asset markets. But today, we're going to have a look at what's been happening to sector balance sheets and the implications for the banking sector in particular. Before we start, there's a few bits of housekeeping I need to run you through, though. The first thing to say is that on your screen, there's a key resources box. In that box, there's several publications that really will help to augment a lot of what we talk about today, support what we're saying and go into a bit more detail. You can download those publications and obviously you can share those with your colleagues. We're also recording today's webinar. You'll get a recording, a copy of the recording, along with a link to a piece that Simon published earlier this week, looking at the very issue of what impact the pandemic will have on private sector balance sheets. That obviously goes into much more detail than we can hope to cover in a 30-minute, 45-minute webinar. Finally, you'll also see on your screens an Q&A box. Type your questions into that box. We'll see them. We'll pick them up. We'll try to answer as many as we can as we go along. But if we don't manage to answer them in the general course of the webinar, then there is some time at the end for Q&A, and we'll get to them as many of those as we can. Like I say, we'll aim to speak for about half an hour, and we'll leave about 15 minutes at the end for Q&A. Okay, without further ado, I'm going to you, Simon, to just set the scene for us. Talk us through exactly what has been happening to private sector balance sheets since the pandemic started, and in particular, how has the banking sector been holding up?
Yep. So I think it's, talking about private sector balance sheets and the implications for the banks, it's just worth sort of clarifying my thinking and sort of framework for thinking about this exercise, and clarifying ultimately what I've analysed in the piece of research that we published yesterday and the focus that you mentioned. So if you think about it, you have an economic shock that has implications for the incomes of firms and households in the real economy. But that therefore diminishes the capacity to service debt, and therefore through defaults, that has implications for financial creditors, and they bear some of the costs too. So that's the way I think about the costs borne by the private sector. Now, in terms of actually answering your question, Neil, about what sort of happened over the past 6 months or so, well, what we have seen is quite remarkably limited costs for the private sector. So it's worth bearing in mind that global GDP fell by 10% in the first half of this year, 10%. Now, in 2009, the world economy shrank by just 0.5%. So given the sheer magnitude of the economic shock, that's all that you knew. You'd be very much forgiven, I think, for expecting to see a tremendous tsunami of defaults at this point in time, dealing a massive blow to the financial system. But we just haven't seen that. And that is, of course, largely on the back of policy action by governments, by central banks, and by financial regulators, which have their actions have been to cushion the blow to incomes for households and firms, but also to provide liquidity both to households and firms, but also to creditors too. So it means that the public sector has sort of gone into the breach, and they have borne the costs of the crisis so far. And the results of the private sector have been quite remarkable, quite frankly, because if you take the banks, for example, losses on bank loans, in the US, we've seen a collapse in GDP in the second quarter. But as you can see in this chart that I've just shared with you, this chart is a chart that looks at the quarterly changes in GDP plotted on the right-hand side, but on the plotted on the left-hand side, inverted, the changes in the loan loss rate. So when that grey line falls, that means that loan losses are rising. Now, obviously, given the size of the decline in GDP in the second quarter, you would have expected loan losses to go through the roof, even allowing for time lags, I would argue. But we just haven't seen that. It barely changed. And the same pictures in Europe and the same in the UK as well. Ultra loan losses on bank loans. And in the corporate bond market, you see a similar picture. Defaults have ticked up, but only to the same extent you'd expect with a slowdown of growth, not a massive hit to GDP like we've seen in this year.
So we've had this huge economic dislocation, a big drop in output, but really because of the backstop to the banking system that's been put in place by governments and central banks, we've not seen an associated, the normal rise in loan losses that we would have normally expected in such a situation. So the governments, in effect, the central banks, the public sector, has had the private sector's back. Is that going to continue, or is something going to change over the next 6 to 12 months that might alter that picture?
So policymakers certainly aren't going to turn their backs on the economic recoveries, but it is, I think it's quite clear that the scale of the support that has been offered so far is going to be reduced. I think there are sort of three groups of countries in terms of what's going to happen to fiscal support going forward. One group of countries are countries that came into the COVID crisis with unsustainable debt trajectories. I'm thinking the likes of Brazil and South Africa, where there were fiscal concerns already, so they're going to be under particular pressure to curb borrowing in the coming months and years, and in fact have already drawn up plans for austerity in some cases. Then there's another group of countries where there are sort of their administrations include fiscal hawks who are getting a bit jittery and a bit nervous at the mounting costs of the public sector response to the virus, and also there are growing concerns about how to wean the private sector off government lifelines. And then there is another group of countries that comprises many advanced economies, many of the more developed countries in emerging Asia and in emerging Europe, where there's not particularly any strong external or even internal pressure to rein in public spending anytime soon. But they will naturally withdraw some of the fiscal support as the economic recoveries gain traction, which will then start to reveal which companies are the unviable ones and hence the insolvent ones in the new normal. I'm thinking along the lines of the companies in the aviation industry and the tourism industries and potentially in office real estate. Those sort of sectors where when you reduce that fiscal support, they will be clear. It'll be clear which firms won't be able to pay their way in the new world in the coming months and years. So the point is that the public sector support will still be ongoing in many cases, but it'll be reduced, and hence they're passing the buck over to the private sector.
Okay, so we're not the government's not necessarily, central banks aren't pulling the plug on the private sector, but we are going to see a pullback of some of the support for private sector borrowers and creditors that we've seen over the past 6 months, for a variety of reasons, all of which make sense. But that leaves, of course, the open question: what does that mean for bank loan losses? Is it the case that we've come through a period of relative calm, as it were, in the banking system, despite the huge loss of output, but just at the point at which the global economy is starting to rebound, it's been pretty V-shaped, as we've been arguing so far. Actually, that's the point at which problems in the banking sector start to crystallise.
Yep. So as the book is passed over to the private sector, we can begin to expect defaults to be on the rise. The question is, are they going to rise to the extent where they endanger global financial stability and have deal a massive blow to the banks, or is it going to be something more manageable? And I think there are some good reasons to be cautiously optimistic that we'll be on the more manageable end of the spectrum in terms of the costs borne by the banks. So I think one of those reasons is that while governments are going to be taking a step back, central banks won't be. They will still be there to ensure the functioning of wholesale capital markets. They'll be there to ensure that financial conditions remain ultra loose and accommodative. So that minimises the risk of running liquidity runs and credit crunches and so on, which would impair assets for the banks. So that's one reason to think that the cost should be manageable. The second is that, generally speaking, coming into the crisis, I'd say that private sector balance sheets were in a reasonably okay shape. Clearly, when you're making global generalities, there are exceptions to that rule. But broadly speaking, I think it's fair to say that advanced economies, households came into the crisis having taken to repairing their balance sheets after the global financial crisis and the housing crashes then. In the emerging world, it's true, household debt ratios have been on the rise in most places, but only to sort of high levels or potentially concerning levels in the sort of many parts of Asia, which are exactly the places where the recovery has been strongest and we're most optimistic about their economic prospects. So it's less of an issue. And then in terms of corporate balance sheets, we wrote a big piece back in March and published that on the Global Service back then, which basically did a rundown of the corporate sector and basically gave a decent bill of health in most areas, with just a few exceptions, such as the property developers, over-leveraged property developers in China, the oil and gas sector in Canada, and a sort of a highly leveraged rump of corporate borrowers in the US too. But broadly speaking, borrowers not coming into this crisis overextended. The third reason to think that the losses won't be gigantic is that many of the ingredients in the recipe for a housing market crash, which is ultimately the biggest threat the banks would face, given that residential mortgages are typically the biggest asset on their balance sheet, just aren't in place today. Many of the telltale signs that you would expect to see, whether that be rising housing inventory, higher interest rates, a consumer mortgage credit boom, and rising housing valuations, we're just not really seeing that, and we haven't seen that in recent months and years. Fourthly, it's important to stress that actually, in terms of the worst affected industries and sectors of the economy, bank exposures seem relatively small. So I've got a chart here which breaks down banks' business loan portfolio by industry in the UK, Eurozone, and Japan. And you can see on the right-hand side here that I've highlighted in red the worst hit economic sectors that actually make a very small proportion of banks' loan books to businesses. It's true, aviation is also in that little blue section in the middle in the transport industry, but it only makes up a small part of the overall transport and communications sector. There's quite a broad category. So again, the exposure to that industry would also be small. You can see on the far left-hand side some rather big bars there for exposure to real estate services. Now, what this isn't including is loans to commercial landlords who rent properties and office space to industries, potentially to the likes of leisure, hospitality, and so on. So there could be an indirect exposure via commercial real estate. But generally speaking, commercial real estate exposure is manageable, sort of manageably small levels in most banking systems around the world. We have better and more widespread data on that. Sort of what one country that really sticks out for having a high exposure to commercial real estate is Korea. There's a smaller exposure in the US, but generally speaking, there aren't too many alarm bells in terms of exposures there on the loan book. And then, of course, thirdly, there is also banks' exposure to leveraged loans. But again, this chart shows here that banks tend to hold the safer leveraged loans. These are loans that are extended to highly indebted companies. And this chart shows, in the case of the US, the banks tend to hold the ones with very low default rates. It's the non-bank financial sector that holds the riskier stuff. So that's four reasons why there are mitigating factors against massive bank loan losses. And just to just wrap it up with a fifth factor, and that's that financial regulators have been relaxing the standards with which they apply the Basel III Accord, and so they're giving banks a bit more breathing space not to have to provision against loan losses for stressed credit as a result of COVID-19.
Okay, well, there'll be a short test at the end of this webinar to see if everyone can remember those that long list of five factors why loan losses may not rise in the wake of government support being withdrawn, all of which in and of themselves sound obviously plausible, and the work we've done on this is there's rigorous analysis behind all of it. But of course, by the same token, a cynic could look at this and say, well, there's always a temptation to say this time is different. Here's a list of reasons why something won't happen, and then of course it does happen. So what if we're wrong? What if, heaven forbid, our analysis leads us in the wrong direction and there is a spike in loan losses, a big spike, a systemic spike in loan losses? How might the banking system be able to cope with that?
Right. Okay. So the way to think about how the banks can cope with a spike in loan losses is to think about how the capital buffers and the profitability is able to absorb those losses. So if we start off with capital, I think it's quite a widely accepted stylized fact of the banking system in recent years that it's been very well capitalized. That's to say that the Basel III Accord and the regulations that were brought in after the financial crisis have been successful and are paying their dividends, and that the banks came into this crisis very well capitalized. So we've got a chart here which shows so for the over 500 of the world's biggest banks, we've tried to summarize here within regions the ranges of capital ratios of regulatory capital compared to risk-weighted assets of banks across the world. And you can see here various threshold levels. So we've got here the red line at the bottom is the regulatory minimum that they have to reach, and the target level above that. So the difference between those two lines is their capital buffer. Most banks, clearly the vast majority of banks, almost all banks, are even above that target rate. So they are sort of comfortably above regulatory minimum. So they have a large scope there to absorb losses in their capital. But of course, the current level of the capital ratio isn't everything, because of course, I think the developed Europe is the case in point here. You can see on this chart on the left-hand side that European banks are amongst the most highly capitalized in the world, but it's well known that they're also amongst the least profitable. And you can see that in this chart here, which shows banks' return on assets. You can see on the right-hand side there, you've got Germany and France and the UK and Italy and Spain. So it doesn't take very much of a hit to your income because of your having to provision for loan losses, for your profits to turn negative and for you to start eating into those capital ratios. So when trying to understand the bank's ability to absorb losses, it's important to take profitability into account too. Now, there are all sorts of moving parts here when trying to evaluate what credit losses mean for capital ratios and the solvency of the banking system. It's quite a messy affair, but under some reasonable simplifying assumptions that we set out in our focus, we've come up with this chart to try and summarize our view about the banking sector's ability to cope with big losses. And what this chart is essentially showing is what is the rate of loan losses that the bank would have to incur for all its financial lines of defense to be exhausted. So that is to say, what losses as a proportion of its outstanding loans would it have to make its profits disappear, evaporate, and for capital buffers to be completely eroded back all the way down, stripped down to the regulatory minimum, where regulators have to step in and recapitalization plans drawn up. So if you look on the left-hand side of the global level, you'd need a loss rate of about 9.5% in aggregate to completely wipe out the banking system's lines of defense. Now, for some context, the loan loss rate last year at the global level was 0.5%. And in terms of the distribution of loan losses, almost all banks had loan loss rates under 1.5%. So I'm saying you'd have to go from 1.5% or below to 9.5% to completely knock out the lines of defence before you get to severe solvency concerns. So there's quite a considerable capacity to deal with high loan losses.
Okay, I mean, all of this is sounding incredibly sanguine. There are some pockets of vulnerabilities in emerging economies. We'll come to those later with William. You've identified some pockets of vulnerability amongst energy producers in North America, leveraged loans. We wrote a big piece on this last year. But in general, the picture is one in which banks are in a much more resilient and robust position than they were in 2008. Before we move on to emerging economies, at a global level, if this picture is going to be wrong in any which way, and things turn out to be much worse, how do you think that is likely to manifest itself, or rather, what do you think is likely to trigger that? What are the kind of big risks to this view?
Yeah, heaven forbid if we are wrong with our macroeconomic forecasts. I think I'd be mainly concerned about getting our labour market calls wrong, because if you have fragile labour markets, weakening labour markets, they quite often go hand in hand with softer housing markets, which is all spelling a recipe for losses on residential mortgages for the banks, which, as I said earlier, would be the biggest threat to them. So I'd be most concerned about us being wrong about the labour market view, and that's ultimately entangled with how the virus progresses and the strength of the recovery in private demand, but also the pace at which fiscal support is taken away. So that's one area where if we were wrong on that could significantly alter our view about what that means for the banking system. But it's also worth outlining, you're quite right, Neil, that I am talking in many generalities, and in general things look benign, but that's not to say that risks don't vary between countries. They do. For example, we are particularly worried and don't have a benign view about the banking sector in India. You name it, it looks bad in India, whether that be the fact that it has a large legacy of non-performing loans coming into this crisis. Almost half its banks were loss-making last year. It's got some banks with capital ratios already near regulatory targets. You can see here on this chart, actually, in terms of the range, you look in the middle of the chart, you've got the other Asia section, and there's a big tail at the bottom of the chart. And they're many of the Indian banks that have a very low capacity to absorb loan losses. So I don't think it'll be long before talk of recapitalisation comes back onto the table. And Indian banks and other banks face the prospect not of a sort of a cataclysm of a single event of a financial crisis, sort of what you saw with the Lehman's moment, but rather we end up in maybe a repeat of the Japan experience in the 1990s, where you have a lot of non-performing loans as a result of the disruption from COVID-19 that sort of gnaw away at profits over a prolonged period and restrict lending as banks seek to conserve capital, rather than sort of the situation facilitating a knockout blow and causing banks to fail. So there's sort of the risks about what you mean by a banking crisis, a different type of banking crisis, you could argue, one of which will restrict lending, and that will ultimately mean less support to economic recoveries throughout maybe the rest of the decade.
Okay, so no knockout blow, but perhaps a slow-burning problem in the banking sector, of course not helped by the fact that we're going to be in a low-rate environment with flat yield curves and low interest pretty much as far as the eye can see. So banks perhaps not out of the woods and facing problems, even if we're not going to get a serious and widespread crises as a result of COVID-19. William, let's bring you in at this point. I want to get to as many of your questions as possible, by the way. Keep them coming in. We've been trying to answer them as we're going along, but keep them coming in and we will get to them. Before we do that, though, William, let's bring you in on EMs. One point that I think marks emerging economies out as being slightly different in this respect from developed economies, advanced economies, is the fact that the state not just stands behind the banking system in many emerging economies, it actually owns a large part of the banking system in many emerging economies. How does that play into this dynamic and perhaps influence the way we think about things going forward?
I think that's right, Neil. And I think in the most extreme case, there's China, where we and many others have had big worries over the past decade about the rise in credit, the misallocation of credit, and the increase in leverage among property developers and SOEs. But the thing that also really stands out about China's banking sector, and you can see it from the left-hand side of the chart I've put up here, is the extent of state involvement in the banking sector. The state-owned banks account for almost all the assets in the entire banking sector. And what that means is that the state is likely to backstop the banks if they get into any problems. We can almost say the same about India, albeit to a lesser extent. You can see India, which is second from the left, where the state-owned banks account for about 70% of total assets. And we've seen over the past year or so the state get involved in recapitalizing some of the state banks that needed higher capital. One factor we also need to consider is the degree, as something Simon alluded to, is the degree to which some EM states can have the capacity to help banks. You can see, I mean, in South Africa, it's one that stands out for this risk. It's one where the state's involvement in the banking sector is very low, but more importantly, the state has very limited resources to help any banks if they get into trouble. The government's budget deficit was already very large coming into the crisis. The debt ratio was rising. It's a big concern for investors. So if a bank was to come into problems, then it's not clear whether the state would be in a strong position to backstop them.
Okay. And what about when we think about emerging economies? The COVID crisis is a bit different because of the fact that banks and central banks have backstopped the private sector, and clearly the extent to which the government owns large chunks of the banking system's assets may influence the extent to which it pulls back that support, as you've just mentioned. But there's also the other aspect of EM banking crises that we historically think about, which is the classic either maturity mismatch, but principally actually currency mismatch on banks' balance sheets, liabilities in local currency, assets in foreign currency, domestic currency falls on the exchanges. That causes problems on the asset side of banks' balance sheets and precipitates a crisis. To what extent is that a lingering risk in emerging economies? Obviously, there has been a shift over the past couple of decades towards more lending in local currency. But is there any kind of what we used to call original sin issues brewing in emerging economies?
Yeah, I think one of the remarkable things about this crisis was that when we saw these big currency falls in March and April in emerging markets, we didn't see the balance sheet strains that we might have expected 10, 20 years ago. We certainly saw those affecting the banking sectors across Central and Eastern Europe after the global financial crisis. It didn't happen this time around. And a lot of that is to do with the fact, as you mentioned, Neil, that banks and borrowers more generally have weaned themselves off foreign currency debts. The one country that stands out and still worries us is Turkey, where there is still quite a large amount of foreign currency lending and foreign currency liabilities of banks. Now, historically, Turkish banks have borrowed heavily from abroad in foreign currencies to fund domestic currency lending. They've then hedged that mismatch with off-balance sheet items. But there are signs that this is shifting. And I've tried to show that with the chart I've just put up here. It shows Turkish banks' net foreign currency position, taking account of both on-balance sheet and off-balance sheet items. And you can see through much of 2018, and indeed if the chart went back further, it would show before that, the net position was slightly positive or more or less in balance. But you can see on the right-hand side that the state-owned banking sector, the blue line, has started to have a large negative net foreign currency position. They're no longer hedging all their foreign currency mismatches. So I think that's one of the risks, that if the Turkish lira were to fall sharply again, and I think that's a considerable risk at the moment, the state banks could find that their capital gets eroded quite quickly.
Okay, so it feels like, at least in the recent past, whenever we've been thinking about emerging market crises and balance sheet crises in particular, Turkey has always been up there at the very top of the countries with vulnerabilities, be it on the external financing front or foreign currency lending or banking sector vulnerabilities. Often it seems to flash red on a lot of the warning signs that we follow. Right, I want to bring in some of the questions that we've been getting here, of which there are lots. We'll try to get through as many of them as we can. Keep them coming, and we'll get through as many of them as we can. Simon, there's a question here about reflecting on a piece that we had written and published. You published in March on corporate sector balance sheets, and asking about how the non-financial sector corporate balance sheet has evolved since then. The extent to which we've seen an increase perhaps in zombie firms as a result of the crisis, propped up by government support or indeed government recapitalisations. To what extent are zombie firms likely to be an issue going forward?
Quite a big issue. This was the point about when governments have extended the support out to the non-financial private sector. They've been giving it out blanket almost in terms of the business rate relief and the schemes to help businesses. Some of the loan guarantee schemes have been a bit more targeted to who they go to, but the point is that the banks and the intermediary are acting as the intermediary step here in how they are getting the funds from these loan guarantee schemes through to firms. And they have very, very poor information about whether the firms are struggling purely because of COVID-19 or because they were fundamentally over-leveraged and unviable companies to begin with. So there was so much uncertainty going on here that we've ended up supporting an awful lot of fundamentally unviable companies. And as the fiscal support is withdrawn over the coming years, this is precisely why we're expecting default rates to rise, because when that fiscal tide goes out, we'll see who's been swimming naked, and we'll see the people who have been the zombie firms, and that will start to impact on bank profitability. In terms of precisely what's happened to banks' balance sheets of the business sector, I mean, they've become a lot more highly leveraged in aggregate. Debt shot through the roof. I mean, I think between March and August, more corporate bonds were issued than the previous 3 years combined in developed economies. And clearly there was a lot of bank lending as well, drawing down of existing credit lines and the use of these government guarantee schemes. So yes, we have got now potentially a situation where we're storing up problems for the future. It's precisely one of the reasons why we're saying that the chances of a sort of a crunch point crisis have been made smaller by the tremendous policy response. But we're potentially going to see this sort of transpire, and it transpires that we have a sort of a more drawn out process of non-performing loans because of over-leveraged zombies over a prolonged period of time.
Okay, thanks, Simon. William, we've had a couple of questions about, we've spoken about how governments in emerging economies sit behind the banking sector, own a large amount of banking assets. What about on the borrower side? What about the fact that governments in emerging economies own a large chunk of state-owned enterprises? I know that you've written extensively in the past about Pemex, about state-owned energy company Eskom in South Africa. To what extent have they been affected, these big SOEs been affected by the COVID crisis, perhaps looking like strained borrowers now?
And the way SOEs are being affected it varies across emerging markets. There's the case of in China, where some of the stimulus is being directed towards SOEs to go back to the kind of traditional concrete in the ground type stimulus to get the economy growing. That's likely to exacerbate some of the problems about the misallocation of resources in China's economy and have slower potential growth. Elsewhere, Eskom and Pemex are two big concerns. They were struggling financially coming into this crisis. In South Africa's case, the government has very little capacity to provide capital injections to Eskom. And there's a big problem from the point of view of the economy if it can't keep the power on. There's a problem for the banks too, because the local banking sector is quite heavily exposed to, has lent quite heavily to Eskom. In the case of Pemex, it's a bit different. It's struggling, and its income's been hit pretty hard by the fall in oil prices. Its debt is a bit different. It's doesn't have much. The Mexican banking sector doesn't have much exposure. Most of its debt is external debt, and in some ways that's perhaps a bigger risk, because the Mexican state may be less willing to provide funding for a company to pay back foreign investors, rather than compared with the South African government providing funding to Eskom to help stave off problems in the local banks.
Thanks, William. There's a related question here, specifically on Latin America, since we're talking about Mexico, which is, in which countries in Latin America do we see the greatest financial vulnerabilities? Clearly, we have a Latin America service which you're responsible for. Where are the greatest vulnerabilities in that region?
I mean, I think the positive point is that the Latin American banks are generally quite well capitalized, and in some cases they've been relatively profitable. As this chart we've got up here shows that they can generally absorb quite high losses. They don't have that that low tail, like Simon mentioned, which we see in other Asia, which is largely the Indian, the vulnerable banks in India. I think the concerns are more that because the sheer scale of the economic hit in some country is going to be so large, there may be quite large write-downs on debt. Mexico is one country that stands out where the fall in GDP is going to be has been pretty big, and the recovery is likely to be pretty weak. Another thing that it's something that concerns us slightly in the case of Mexico is that while the banking sector is small, the cost of recapitalization wouldn't be very large. In the current leadership, I think, is quite left-wing populist leadership and might be quite reluctant to bail out the banks. And I think sometimes we see if there are slow policy response, that can lead to a spike in risk aversion and maybe problems in the wholesale market.
Thanks, William. We've had another set of questions, this time on financial vulnerabilities in Africa and Nigeria in particular. I'll come back to you. I'll let you get your breath and come back to you on that one. Instead, I'll come to you, Simon. Several questions here on the property sector, one of which is just clarifying views on the extent to which we see loan losses rising as a result of problems in the property sector. Actually, I think it's one point to make clear on that, actually, is that when we think about property, it's important to distinguish between commercial property and residential property. For those of you that are interested in the commercial property, we've got a big team looking at this. They've just started to publish a whole series of work looking at the future of property. Look at that on our website. One of the messages that comes from that, actually, is that behind a lot of the bleak headlines about the commercial property sector, actually it's a lot more of a nuanced picture. It's going to be extremely challenging for offices. Retail was already struggling before the pandemic hit and is going to struggle even more as a result. But there are some pockets of bright spots in the property sector too, when we cast our mind forward over the next 5 years or so. Logistics, warehousing, some industrial units, residential property too, an institute with institutional money behind it in the US. So there's lots of areas, there's lots of bright spots that sit behind some of the more gloomy headlines on the commercial side. So look on our website for that. Simon, I'm going to come to you on the housing markets, because one question here is about the US market. Some of the data there has been pretty good. The Australian data has been okay too. To what extent are we starting to see froth or housing markets starting to run hot as a result of the looser monetary policies being pursued by central banks?
Yeah, so we've actually seen house prices rise in most major economies since the first quarter. So I think Spain is one exception where the prices have fallen a little bit, and one or two other countries that have seen prices fall. But generally speaking, we've seen rises. In Turkey, prices have been shooting through the roof, but that's more of an inflation story there. But even in real terms, house prices have been rising in most countries. So in that sense, there's been obviously policy supports to the housing market, whether I'd call that froth or whether we're just confusing here a release of pent-up demand from a couple of months in which there were very, very low levels of housing transactions. And of course, there's hits to the supply chain as well. So I think that if we're looking for signs of froth, we can look at the valuations of house prices relative to disposable incomes and relative to rents and relative to general consumer prices. And on all of these metrics, some of them show slightly different things. It's never an absolutely crystal clear picture, but we are not of the view that there are some housing markets that are absolutely scorching hot and ripe for a large correction. Now, it is true that there are risks as the labour markets potentially weaken in the coming months and years because of withdrawal of fiscal support, which is precisely what I flagged earlier as one of the major risks to the outlook for the banks. But it is worth pointing out that with prices having risen so far in this year and in previous years too, it means that even if we get a small correction in house prices, the sort of collateral values that banks can recover from the mortgages that have already been originated will be higher than when they first issued the loan. So you'd only get a serious problem if we saw rather large price declines, which means that these house prices go into negative equity, and then the banks would incur losses when they try to go off and foreclose on properties. But I think we're quite some way away from that point. I don't think regulators and policymakers want to see a situation in which banks are going after borrowers who are struggling because of the fallout from COVID-19. So to wrap up that, I think that there's not huge signs of froth, even though there's been clear signs that house prices have not been declining. But I think that we are also quite far away from weaker labour markets filtering through to weaker housing markets that could, to the extent that it could inflict a severe damage on the banks.
Okay, thanks, Simon. I've got one eye on the time, William. So the last question goes to you, and it's the one that I mentioned earlier about financial vulnerabilities and weaknesses in sub-Saharan Africa, in particular in Nigeria and Kenya. How's that likely to play out?
Yeah, I mean, just for sub-Saharan Africa as a whole, there are clearly lots of different factors going on. I talked a bit about South Africa earlier and the weak fiscal position and how the banks might struggle there. For Nigeria and Kenya were less concerned. It came into this, the country's banking sector came into this crisis quite well capitalized, and actually, while the economy has been very badly affected, it's not suffering a very large fall in output. It looks like GDP over the year as a whole may be flat or may even grow a bit in 2020, and then growth might go to 5 or 6%, so limiting the risk of large loan losses. We're more worried about Nigeria for two reasons. One is the exposure of the banking sector to the oil and gas sector, which is struggling with lower oil prices. The second factor is there's quite a high degree of foreign currency lending in the economy, and the naira is coming under pressure. It's being very carefully managed by the central bank. They're avoiding a big devaluation, but there's clearly downwards pressure on the currency. And as the currency weakens, that may make it harder for borrowers to repay. So there's risk of loan losses from that sense. And while the costs of any recapitalization might not be very big, the government has very little capacity to do that. It's in a very strained financial position.
Thanks, William. And of course, you can find out more about both of those economies on our Africa service if you're interested. Right, we're coming up. We're nearly out of time, so I think we'll draw this to a close there. Thank you very much for all of your questions. Thank you for contributing to what I think, I hope, has been an interesting and stimulating debate. Don't forget to download all those pieces in the key resource section. Don't forget to share them with colleagues if they're of interest. If there's anything there that you don't get within your current subscription, then let us know and we can arrange for you to see it. Have a look too on our website for further webinars in this series. We're doing one next week with Vicky Redwood, who's our Senior Economic Advisor, on the inflation legacy of this pandemic. That's clearly going to be a huge issue, and one in which Vicky's going to argue most of the thinking's a little bit muddled, and perhaps the consensus may be a bit wrong. So we're going to kind of challenge the consensus on the inflation outlook. Have a look out for our webinar on that this time next week. In the meantime, it simply remains for me to thank you all for listening today, to say that I hope to speak to you again, see you again virtually at least, if not at one of our physical events, then virtually at least at a future Capital Economics event. Thank you all for listening today, and have a good day. Goodbye, and thank you.